Welcome back to the Cashflow Chronicles. We are back with Chris Patel as always. Today I want to talk about something very different. I didn't discuss this with Chris beforehand, so we can either pivot from it or we can just run with it. But I want to take today as an opportunity to look at just how people may have been duped by following short-term media and basically not being able to take an opportunity to step back and look at things through their own perspective and through their own lens. And what I mean by that is specifically looking at, okay, these people think that the market's going to pull back 5%, so I'm just not going to add any money. And there's so many stories that I have to tell about individual investors that have approached me over the past 18 months to 2 years since we've reached the last all-time highs, which for those of you that haven't been watching the news, we are back at all-time highs for the NASDAQ 100, the S&P 500. The Dow is way beyond all-time highs at this point. And many people, I think, are now just asking themselves, do I get back into the market? Well, my question to you would then be, why haven't you been investing in the market for the last 2 years, right? Buy low, sell high, and here you are trying to buy back when we're out back at all-time highs. And so I'm curious as to, if you haven't been doing that, are you letting the mainstream media or just the normal, say, Fox Business or CNBC headlines drive your train of thought to not be able to think independently, not think for your own portfolio over the long term? And so I think that that's part of the big problems that I see a lot of individual investors do, is they don't have their own long-term investment sort of thought process or long-term plan sort of thought out. Now, I'm not saying you have to specifically buy and hold everything forever. That's not the goal, right? That might not be for you. That might be, but in you need to separate, say, people's perspectives to where you are going to end up in the long term. Now, let me give you an example. The folks on Fox Business, the folks on CNBC, Squawk Box, those guys are telling you the news, what is important that day, not necessarily what's important for the next 3 months, 6 months, a year. They might get into that too a little bit, but they're talking about what's pertinent that day, what M&A is going on that day, what mergers, what companies getting bought out, what bonds are kind of being issued at the treasury level that day, right? Where things are from a macroeconomic perspective. And that might feed into where you look in the next 6 months to 12 months in your portfolio. But I think what it ends up doing is scaring a lot of people, thinking that there's always an imminent recession. But you have to think that these people are trying to not help you. They are trying to sell advertisement dollars through the people that give them the advertising money. They're trying to sell advertising space. So what do? They bring up this panic. I need to be watching CNBC. I need to be watching Fox Business. These are the people I need to follow because they're telling me all this relevant information. They're trying to fill up ad space. In actuality, they're not there to truly help you. So what they're just trying to do is fill out their 24 hours in a day to make sure that they have you keep coming back. And at the end of the day, they don't have your best interest at heart. And I just want people to kind of recognize that and hear that and say, okay, I don't need to necessarily trade everything that's on CNBC. I need to pick and choose what fits right for my investing strategy, what fits right for what I want to do in the long term, and then stick to it. Be true to yourself at the end of the day. Chris, thoughts?
It's a
lot,
know, man. No, I mean, I watch CNBC and all these other things to get an idea of what's going on in the macro, but individual company wise, I tend to just do my own research. CNBC, Bloomberg, all these guys, they do a great job of bringing new perspectives into the limelight, but they don't necessarily like give you a one direction to follow. And so sometimes people they could get lost in that, because you could have someone who's uber bullish on things and someone who's uber bearish on things, and it's your job to piece together who you want to basically follow. So I just think you have to just know who you trust on there when they come up with their data. Let them give a reason to argument what, why they think the market is going to do what they believe, and then let things play out how they're supposed to. Not everyone calls it right, not everyone calls it wrong. A good investor tends to look at fundamentals to buy things. When things are cheap, you buy, and when things are expensive, you either sell or you hold. That's just the name of the game when it comes to investing. So I think right now there are a lot of areas in the market that are relatively cheap, considering that we're probably going into a macro environment where rates are going to be lower. So, you do the math and you can find yourself in some really good opportunities, which are relatively safe. So I think right now you just have to know some basic math. When the biggest challenge to most investors making money in the market, and it's something that I've dealt with too, is they don't do a lot of math. Like, just let the math guide you. Like, you'll be very surprised at how easy investing is once you just let math do everything for you.
Hmm.
Like, here's an example of something that, just something to consider. If you have a stock, it's a stock that's been running, pretty steady for a long time. If it's doing share buybacks, over time, the share price is going to grow. Why? Because the pie is shrinking, right? Even if revenue stays flat for the next 5 years, as long as it's doing share buybacks and it's doing them consistently, the share price is going to go up. It's just inevitable, right? The question, the thing to remember though is, can the cash flow support the share buybacks? Because I mean, if the company's just taking on a ton of debt in order to do share buybacks, then there's no point. So even then, there's like caveats. But what's interesting is most of the time you can sort of like project out what earnings are going to be like 5, 10, you know, maybe like at least 5 years ahead,
Hmm.
just based on the amount of share buybacks that they do and the level of earnings growth that they have. One of the things I realized a long time ago when it comes to statistics is that businesses, they do deviate a little bit here, and not just businesses but anything, they do deviate here and there, but for the most part they're pretty steady. So if you have a company that's growing like, I don't know, 10% a year, yeah, it could slow down to 5, but it can also accelerate to 15, right? And so you kind of want to give them that median of, okay, this is what the model currently looks like. And under this circumstance, what is the valuation going to be like? And then if a company's been around like for a really long time, you could run some historical numbers and get some better valuations there, where it's like, oh well, historically this sector is traded for X, you know, value. Now it's trading at this value. So okay, let's see if that makes sense, whether or not to buy it or not. So there's different valuation methods that you can use. But the key is to apply the right valuation method per company. And I think that's where investors can get it wrong sometimes too, where they look at certain metrics that may end up almost like trapping them a little bit.
Hmm.
Because when they buy things like, oh my God, I'm buying this super cheap, and it could be a value trap, or the other way around where they sell something thinking, oh my God, all the upside is already done. Like Nvidia, right? A lot of people were selling Nvidia because they're like, oh, the upside is done. And then you look at it, it's like, oh yeah, but they're growing their PE like crazy. So next year the forward PE should be a lot lower. These are like little things here and there that you just have to contend with and learn as an investor. And if you don't want to do all that, just hang back, buy some index funds like VOO, and just relax. You don't have to do anything.
No, I think that that's really wise. It's something that we hit all the time on the channel. It's like I feel like sometimes people want to put in just enough time where they think that they're smart, but they're not smart enough to really understand where certain risks and uncertainties can really play into completely sideswiping their entire investment thesis. And exactly what you had said, Chris, they might do a little bit of research. They might go on Investopedia and say, oh, price to earnings ratio. I'm gonna apply that blanketly across absolutely everything that I do, and then a company just hits profitability. Like I can't tell you how many times people are like, "Well, Palantir is overvalued, or Dutch Bros is overvalued, or Rocket Lab they don't even have a positive price to earnings ratio," and it's just like, I get it, like I understand what you're talking about, but price to earnings is when you have a very established company, and you're kind of getting to the point where it's getting to a place where it's maintained profitability for quite some time, and it is a metric, but it's not the metric, right? And as you alluded to, some companies will trade comfortably between 20 to 25x multiples. And I would say a Pepsi should trade in between there, a Google should trade in between there. And I think any premium sort of company, best in class sort of company, should trade between 20 to 25 as a blanket sort of statement, but that doesn't mean it should. You have like a Microsoft trading at like 38 times. Does that mean that Microsoft shouldn't trade at 38 times? Well, Microsoft is also growing at a pretty expansive rate. So it might not be trading on, say, 20 to 25 times 2023 earnings, but it might be trading in, 20 to 25 times 2024, 2025 earnings. So those are key things that you kind of need to look at and take into account the growth aspect of things. And I think the problem that a lot of people, will do is they'll listen to headlines and say, ooh, we might see some 5-10% pullback within the next 6 months, and it'll stay uninvested for that time period. And they'll wait for some sort of clear air and then say, well, it's kind of rebounding. It hit the 5-10% pullback, but is it going to go down to 15? Is it going to be 20? And sometimes I think they try to become a penny wise and a pound foolish with respect to that, right? They'll try to count all their single percentage points. And the same thing about, like today, for example, Chris, I messaged you and I said, what are we selling? What are we buying in the portfolio? And you said Celsius. Some people might be saying, well, Celsius is just at $50, right? Why are we buying it at 53? It's like, you might say we lost 6% on that particular opportunity cost. Why didn't we buy it at $50? I've been looking at it at 49, 50. Why didn't we kind of jump sooner? And at the end of the day, it's just like, it doesn't really matter because the stock is probably going to go north of 100 in a couple of years anyway. Is it really going to matter that we bought the stock at 50 or 53? Yes, we lost 6%. But when you get to the point where you're getting over $100 a share, you're still going to be close to 100% return. So does it really matter? And I see so many people truly trying to time the market. And most famous story for that for me is when I tried buying Tesla during the pandemic. And I don't own any Tesla, but I said, you know what? If Tesla decides to go on this skydiving trip as it did during the pandemic, and it went down to $350.10 per share, guess who was the idiot that had a price target for $350? And it was me. And I would have had, I don't even know how much money return, because it was 350 during the split or before the split, and it's split so many times thereafter. But I'd be sitting on probably north of $100,000 if I had kept it all. Because it easily went up 5-10x. I don't know exactly what the number is. But regardless, it's like, I laughed in the face of like the opportunity, just being like, well, it wasn't meant to be. Well, I'm the dumbass, right? I let literally $1.50 or something like that of the money that I saved end up being worth $100,000 or so in profit, because I was just like, well, it didn't get down to 350. So it's just like, well, the price was 350 basically. Why didn't I just say 350.10 is good enough? And I let the day close out, and here we are, right? It was an opportunity to buy it, and I knew it was cheap then, and I obviously missed out on that opportunity. I see other people saying the same, like, ooh, Rocket Lab at $4.20. It's just like, does it make a difference if you buy it at 425 versus 420? Like, where do you think the stock is going? I mean, are you day trading here? Are you trying to make a difference between, 1 penny or 2 pennies? It just doesn't make sense as to why some of these people try to literally get things on a trying to be penny wise but a dollar foolish, right? If you really think the stock is going to $100 billion, does it really matter if you're buying it at a $2 billion market cap or a $2.01 billion market cap? It doesn't. Sorry, Chris.
Let's review the portfolio then. Let's see what we've got going on, how we're performing.
Let us see. Let me just double check.
I'm actually eating Taco Bell. My wife, she's got back from work.
What's the order?
She's like, what should I think it's just a cheesy rice and bean burrito and a chalupa.
Both good choices.
Yeah.
All right. So we did make some cuts. Chris, I'll relieve you so you can keep kind of eating there. So we did a brief purchase last week, I think sometime last week, into IWR, which is a small cap ETF. And so it was a small cap value, I think, Chris, if I remember correctly. Yeah, so we trimmed that. And then we also had Nintendo in there. I think we were up about 7 or so, maybe 9%. I don't remember on Nintendo. It doesn't really seem like that's one of the things that we're looking at right now. So while it was making money, it not necessarily, I think, core to the portfolio right here. And I think there was a third one. No, I think that was the only two actually. And then with the proceeds from that, we bought a share of Celsius, which I've been looking at pretty extensively in the $49 to $50 range and wondering when I personally might buy some Celsius. But there was three positions that Chris was talking about potentially taking today. And we only really had capital for potentially one or two of them if we split up maybe into half shares or something like that. So we just decided to put it all into Celsius. But everything in terms of the portfolio is looking okay. We're just under $1,100. TQQQ is still the best performing opportunity. But with that, I'm sure in the future we'll see the volatility that will come with that. The worst performer is TEL-Z, but that's more of a dividend play for us and also a 5-year hold, potentially 4 or 5-year hold, I think, for that one. Or is that Brookfield? I always get them switched up, Chris. Is the Tellurian preferred shares, is that 2025 or is that 2028? I forget. I always switch them up.
So Tellurian, that one is the possible doubling play, the one where it could be acquired. Other than that, we could just see some nice dividends, the 20% plus dividends per year.
Which one's the one in perpetuity? Is that the Brookfield or is the TEL-Z?
Yeah, it's the Brookfield one.
Okay, so the Tellurian one's to 2028, right?
Mm-hmm.
Okay, yeah. The Brookfield is the one in perpetuity. Okay, so
yeah,
Bros is doing well. What else do we got? Orsted has continued to do well, 17% on that. HashiCorp. I asked Chris, we still need to do an episode on HashiCorp and Extreme Networks, and maybe we could talk about it today if Chris can muster up the energy. That's up 15%. You were right on that. I was sitting in a subway, and Chris is like, messages me randomly out of the blue, as he does. And he just says, buy HCP and buy EXTR. And I was like, whatever. And, they're small positions, right? They're like, what, 35 and $48 a piece. So not big. But yeah, Chris mentioned that one. So pretty cool. And for those of you guys that are not already linked up on our Cashflow Chronicles channel, I'll make sure to put the link in the description. But the Cashflow Chronicles channel, actually, we just did our initial due diligence on not initial, but we did some due diligence about it, I think back in August, September, and talked about it. And this is when the stock was in the 60s. Actually, it was pre-split. So it's effectively the post-split $60 or so share price. I think it was like 130 or 125 or something like that pre-split. They did a 2-for-1. And so back then we were looking at it and we were pretty impressed with it. We just thought it might take an opportunity to wait for some sort of pullback because it seemed like it was running a little bit hot. But now that we've had the sell-off after the founder passed away, I think some of the family and stuff has been selling off. So it's taken a little bit of a tumble from its recent highs down to the 50 or so share price range. So we took that opportunity. But on the new channel, which is where we're eventually going to move over to, which is the Cashflow Chronicles TV channel, which I'm putting in it's in the description right now. Also putting in the chat box. We released our initial backlog item of Celsius today. So if you're curious about we literally go line item by line item, why we think it's a good opportunity. And then the second piece in there is we also talked about Carnival Cruise, which I talked about Carnival last week, actually, Chris. On Thursday, I think you had just gotten into Florida, so you weren't actually able to attend that one. But the numbers came out on Thursday; they look pretty damn good for Carnival.
Yeah.
So
I'm sad I didn't add to the position. I don't have any position in Carnival. It was one of those that I researched, but it was one of those things that I just thought I had more time before the stock would recover. But it's recovered nicely,
All right.
So a couple of things I just want to highlight, especially with Celsius. I mean, maybe it is a fad, maybe it's not, but the point is it's all over the place. This is, to me, Celsius is a clear Peter Lynch play, right? Where you don't know why it's so popular, but it's everywhere. You remember how Red Bull kind of came into the market? I was in college at the time where they used to have those Red Bull trucks. They would come around. So I knew Red Bull was going to be a big thing. And so everyone drinking Red Bull, everyone, mixing drinks with Red Bull, blah, blah, blah. So
Right.
now it's come to a point where I think Celsius is doing the same thing. Their advertising is so viral and their presence is felt everywhere now. Like no matter where you go, you're starting to see Celsius as a staple product, primarily because of the distribution abilities of Pepsi, because Pepsi has a long-standing relationships with with end users and stuff. So that distribution network helps Celsius tremendously, and it is a hit with a lot of people. So right now Celsius is still very, very early in in the total market that it could possibly get to. And also, I'm not so sure that they've had much success when it comes to international, but that's
Mhm.
something that, if they tailor it right, they could also become a global brand too, just like Red Bull is. Red Bull, unfortunately, I would love to buy Red Bull, but they've always been a private company, you know.
Mhm.
So it hasn't really been something that I could end up going into. But I could tell you right now, based on what I'm seeing, everywhere I look, I'm seeing Celsius. And so
Mhm.
I am okay with paying a little bit of a premium for Celsius as long as they maintain that growth rate. I think Celsius is an easy double from here.
Yeah,
You know?
I think easy double. I think will it be able to grow into a 50 odd $1 billion valuation like Monster? I don't know. That might be tough, but I could see it growing to a $20 billion organization. And that's kind of where we're at, right? I think we're paying 11, 12 billion market cap here. So, I could see it going to $100 a share. And, who knows? They're cash flowing a crap ton. And so I think the opportunity with that, I mean, if you're able to buy back a bunch of stock, then in the future could be an opportunity. So
Yeah.
Intel, that's a curious one
Hmm.
as well. But I'm trying to think, Chris, what other thoughts do you have? I mean, about talking about specifically, do you think that people get stopped up with respect to, overdoing it with respect to, what's going on in the macro and things of the like, or do you think that people actually are doing a pretty good job being able to navigate and uh, I don't know. I guess it's a question.
No, I mean you have to be aligned with macro. You have to understand where the macro, like where we are in the macro, right? You can't just ignore the macro and think that your companies, the ones that you're looking at, are completely insulated. It's just not how it works. You have to look at the macro, see if the business conditions are right for your industry, and basically invest that way a little bit too. Like here's an example: commercial real estate. Commercial real estate is going under a lot of pressure right now because of the work from home phenomenon. Combine that with a lot of the interest rate rises that we've had, the sudden interest rate rises last year, and a lot of debt that's coming due that's going to have to be refinanced all at one time. So the industry itself looks very weak, but among those weaker players, you're starting to see people kind of jump in and buy things that are actually relatively cheap, considering the importance and like of the assets themselves. So as an example, I was listening to a really interesting podcast. I mean, it was someone in the commercial real estate space, but it was a very interesting one that says, look, right now people are looking at the interest rates and saying, oh my God, this is really bad. Like a lot of these buildings are not going to be able to get refinanced, X, Y, and Z. But what they're also forgetting is that no one else is going to be able to finance new construction,
Hmm.
which means that the number of future supply is going to be limited. It also means that right now, with inflation high, that means that the asset value, which is is going to go up, even
Right.
because the replacement costs are going to be tremendously higher. So imagine a building that was built, I don't know, 15 years ago, right? It's fully amortized already, and you don't have to keep building it over and over. You do have to do maintenance, but for the most part it costs more to build a new building than it is to just service an old one. So just keep that in mind. And I'm like, "Oh, that's a very interesting concept, So I think right now, when you value real estate, there's multiple ways to value real estate. Definitely, um, there's definitely things that can help you do that. For the most part, I'd say buy high quality things in areas that are just always going to be in need, like pretty much like city center. So I'm looking at commercial real estate right now. I'm looking for a few companies that I think can do it amazingly well over the next 5, 10 years. Once the market really catches up. And in the meantime, these companies are not going to have too many issues because they have really long-term contracts and they're able to weather the storm pretty well. So I think with commercial real estate, we could be having a 2008, 2009 kind of moment where everyone was just selling off houses, like, oh my God, no one's going to live in houses anymore. And it's
Yeah,
like,
yeah.
okay,
No one's
10
going to
years
use office
later,
space anymore, sell it all. Yeah.
yeah, 10 years later, exact opposite happens. So.
No, I think you have something well to be said, right? It's like just like how people probably should not run out and go buy single family residences in the middle of places that people aren't moving to, the middle of random place Ohio, the middle of but if you're buying it in places that people are moving to, yes, there might have been a, let's just say, overabundance of purchasing and demand in specific areas like Austin and a few other cities. But in the long term, I think those opportunities, if you buy them appropriately at the right price, will do fine in the long term. So I think you're 100% right. I mean, people are still going to go to work in Houston. People are still going to go work in Dallas. People are still going to go to work in Chicago. People are still going to go to work in New York, right? Those places are not going to go away. And, Florida probably as well. Like you probably have some big municipalities in Florida that are expanding like crazy right now because people are just continuing to move more and more to Florida because of their policies, right? It's having a large max exodus from, say, some of these more, and we saw it a lot during the pandemic, some of these more restrictive states to some of these places that are a lot more lenient towards business growth, towards towards individual freedoms and stuff like that. So it's interesting that people always go to like through these pendulum swings almost, and those pendulum swings are the times where you can make outsized returns, right? Just like SLG, you guys presented that opportunity to me, and I was just like, well, this is kind of a no brainer, right? It doesn't make sense as to why it's an opportunity um, of a lifetime where you have these A class assets, and I think a lot of it just had to do with just a perfect storm of opportunities. And there was the same time when like you get presented these opportunities rarely, right? And they line up for you, and it's not trying to time the market. It's more about like if I'm just sitting there, some of these things, like if you're sitting there waiting for a commercial real estate crunch, you're going to be sitting probably for like 8 to 10 years, right? Like you said, like there probably hasn't been anything like this for commercial real estate impacts since the 2008 financial crisis. So what are you going to do? Just try to sit there and time it? No, but when the opportunities like allow for it, you can take that opportunity and that plunge. Just like, for example, the perfect storm happened with 2014, 2015 when the oil price dropped, from the hundreds down to the $30 range in early 2015. And then, I looked and I was like, man, like, what are all these stocks? A natural. And then also, it was a perfect storm for iron prices, for copper prices. And if you think that the oil industry got hit, you should have looked at all these mining companies that took a hit. So you had almost the same sort of issue during like the pandemic as well with like Vale and BHP and a few of those other mining companies. But BHP in 2015 took an absolute dumpster dive. It was down to $16 a share. And I'm like, this balance sheet's pretty good still, right? I'm like, if these guys go out of business, I was like, we're going to be in much greater shit than I could probably recognize. So that's why I bought. At the time, it was like $3,000 for me, which is a lot back then. And it turned out to be one of my best investments. I'm up 350%, right? And it still pays me a dividend twice a year. So it's one of those things where if you have the opportunity and you are looking, you can make good investments. But I think so many times people get over anxious and they don't have enough cash on hand, or or anything like right now, Chris. Like we don't have enough cash on hand on this public portfolio because we only inject capital once a month. You know.
Yep.
Sorry.
That was bad on me. I should have waited until I got thought across to take a bite, but whatever. So right now, I think commercial real estate, there's some opportunity. Today, commercial real estate did well. There's some opportunities in the banks, regional banks especially. With a lower rate environment, their AOCI losses should dissipate, so that's doing well. So if anyone here is in the Patreon, they know about Truist, they know about KeyBank, they know about Zion, all those things they know about. And then on the real estate side, I'm doing more deep dives into specific companies that have tangible assets that are going to do well. There's one thing that I posted on Twitter today. I kind of wish I didn't, because I did let a cat out of the bag a little bit, and I might actually just go back and delete the tweet now.
Same for the Patreon, my guy.
Exactly. Yeah. Let me delete that. Only 4,500 people saw it, so I'm not going to talk about it too much.
That's low for you, so yeah, you're good.
But there are definitely opportunities in the market right now, around the world, specifically in a country close to us, which could actually do very well. And so they have a sponsor here in the US. The US company has done extremely well. And so their affiliate, who's listed in Mexico, they're applying the same business logic down there with a little bit of like flavor that's more on their side. And so over time, they'll do fine. There's still a lot of strength in logistics, warehouses, things like that, data centers, cell phone towers, like tons of infrastructure investments that there's a lot of money to be made. And right now, with capital being so expensive, people are kind of like shying away from that specific sector. But over time, it's going to do exceptionally well, So
yeah. So I had speaking on this, I won't say exactly what country you're talking about, but I saw the tweet, so I'm one of the 5,400 or 4,500 people. But there's a question that I have for people. A lot of people think that they need some sort of emerging market exposure and stuff like. I'm more on the lens, and I could be wrong on this one. I'm more on the lens of the US companies get a crap ton of international exposure. So my question to you is, not you, Chris, but just the audience in general, why are you truly trying to get emerging market exposure? Do you want non-US currency exposure, right? Do you want to be in the euro? Do you want to be in, say, the Indian rupee? Like what exactly do you actually want to be in? Like, do you still want to be in the dollar? Or do you just want to get the sales and revenue from international? Because if you're asking me, I mean, the S&P 500 gets a shit ton of capital from international. And I used this yesterday on the stream. When I lived in Trinidad, I saw Pepsi, I saw Coca-Cola, I saw, Gain. I saw all those sorts of US focused products that were made by P&G and Colgate Palmolive and all these other companies importing into Trinidad. And I know Trinidad is not the only country in South America or in the Caribbean that does all this importing. So you think they're getting a crap ton of international sales just like they are in the US. So I think when you ask yourself about emerging markets, you have to think not all emerging markets are doing well. And that's part of the blanket problem that I see is like something might be labeled as an emerging market, but be completely dragging its ass and not really pulling its weight. And so sometimes that's why some of these sector ETFs, like India specifically, has been doing really well. Maybe not as good as the US, but has been doing well. But things like that where you can maybe look into some of these opportunistic sort of top 50 funds or the FTSE 100 and find companies that, if you're truly doing the scanning, that are doing really well and continuing to grow, right? And I think that's part of the problem with buying any sort of sector ETFs or just like ETFs in general. While we're talking about it, is like sometimes when you buy some of those focused ETFs, you really have to understand all the companies that are kind of in there on a blanket statement. Which ones are going to perform? Which ones are you talking about? Just the top 3 performing companies in that sector? Then that's kind of cool. I'd probably want to be in that one. But if you're talking about an exposure to 200 companies in that sector, I don't know if I want to be a part of that. Like, you think about it, how many good banks can you name on your 2 hands, 3 hands, maybe in the US financial sector? And then you think about all the banks that are in the US financial sector, you're thinking, I don't know if I want to invest in all of them, but something that you think has good balance sheets and stuff like that, I would like to get my hands on. So it comes with that kind of burden. It's like you can't just blanketly, and Chris kind of said this earlier, like you kind of have to do some math. You kind of got to do some work. It's not going to be given to you. You think about it, anybody with a social security number and a pulse can open up a brokerage account. So you're competing with everybody, right? Anybody and everybody can pretty much look at what you're doing and has access to the same information that you do. Where you have to differentiate yourself, if you truly think you want to be like some sort of Warren Buffett like figure, is by putting your damn blood, sweat, and tears into actually doing some damn due diligence. Where I think so many people, they just think that they can come on Cashflow Chronicles, watch an hour once a week, and then not tune in for a month and be like, my stock is down. It's just like, well, how much time did you actually put in? Well, I watched your stream a month ago, and I haven't really dedicated any time to the investing markets or the equity markets since. It's like, well, there's your answer. You tried to do 1 hour's worth of work in a month, and you expect to get Warren Buffett like results, who's doing 60 to 70 hours a week, right? And also decades of experience as well, right? So that's where like the piece of where trying to become a master kind of comes in, right? I stumbled. I changed my investing objective so many times over the last 10 years to now where I finally feel like I'm comfortable within that. So anyway, sorry, I'm rambling on there, but I just think it just goes back to show, people can't just put in a little bit of time. They want to find the good stuff like you, Chris. They have to put in the time and comb through hundreds of companies.
Believe it or not, I'm looking for a quick video just to show you something that was actually very interesting that I saw earlier today. And it was regarding ETFs, actually. And it's very interesting how the ETF, why ETFs over a long period of time do exceptionally well. Just give me 2 seconds to find it. I should have bookmarked it, but it was a very interesting video. Give me 1 second. Come on. I'm looking through my YouTube history right now, and I just I didn't realize how much Vikings I've been watching.
I don't even know what Vikings is about. Is that on Netflix?
It was actually on the History Channel. Vikings is a really
Channel.
good show. Yeah.
I'll have to watch it.
I don't know. I can't find it. I'll find it another time. But
But
basically,
for those people that are I guess getting too in tune with Echoes who joined the chat, don't give them any sort of light. I actually want to say something. So Strongman actually preaches something that I believe that works for 95% of the people, right? He preaches just investing in the S&P 500 pretty much, or I think he does VT, which is the total stock market index from Vanguard. Low cost, you get total American exposure, international exposure, and you're kind of just good to go, right? And I think that, to be honest with you, I think that's I don't like really all the international piece exposure. I'd like more specifically American-based companies, more specifically the S&P 500, because that's actively managed kind of, but and it's 500 profitable companies. You can kind of guarantee that they're profitable companies. So I like that aspect of the S&P versus say a VT, which doesn't necessarily guarantee that. But don't necessarily hate on somebody's strategy, right? They might have an extreme way of presenting that material, but in kind, I think that they actually are preaching something that is very good that most people should listen to. Because so many people will talk to be like, oh, they're just preaching VT and then the S&P 500. It's like, I'm also preaching most of that most of the time. The S&P 500 is probably what most of you in this chat should be doing, because sometimes I'm just going to be honest with you. Like, I love you all as a chat, but sometimes the things that you guys bring up about stocks and what ticker symbols you want us to look at, I scratch my head sometimes to be like, I don't understand why you're investing in this company. And so I love you all to death, and I appreciate you guys coming as well. But you have to listen to everybody, even if they're not right, or if they don't meet your perspectives, it might be right for them. And so, just like with Strongman, I mean, he likes VT. I get it, man. Like I can see where in a world I would be in the same. If he can spend his time instead of looking at stocks, or I do this because it's a hobby, right? I love stocks. I like looking at balance sheets. I like that. Not a lot of people have that hobby. They like to go hiking. They like to go mountain climbing. They like to go do X, Y, and Z. It's like me. I'm, in the computer screen looking at stocks and balance sheets. That's where I live. And so it's easy for me to do a little bit more due diligence and find companies that might have outsized returns. Instead somebody else will hear a stock tip around the water cooler at work and think that that's a ticker symbol without doing any due diligence that they're going to stick onto because they heard Bill from work talk about it. So not saying that, VT is the right or wrong way, but it's the S&P 500 of the indices, can be an opportunity for people to really shut their mind off and focus on what truly they're good at. Some people are legit just good at making their money at work at their 9 to 5 and just putting it into a stock market index and letting it go for 20, 30 years.
So let's watch this real quick. This pretty much gives you an idea of why index fund investing does well. And they give a really good example too. I mean, some of the stuff that he does is pretty much insults Jeremy, which I don't like, but whatever. It is what it is. Can you hear this or no?
No, I was about to say.
Okay, hold on. Let me just. Back.
In today, give the most weight to companies.
Here we go.
Indices, especially the market cap weighted indices, give the most weight to companies that have large-sized market valuations, and less weight to the lesser valued companies. The headline indices like the Nasdaq 100 and S&P 500 also have a limited number of stocks they consider to be included in the index. For example, the Nasdaq 100 will only have the top 100 companies arranged by their market capitalization. In their periodic rebalances, the lower weight companies are excluded from the index to make space for the new companies that have gained market capitalization since the last rebalance. This way, emerging companies are included in the index and the laggards are dropped off. Some of these new inclusions continue to grow and their weight keeps on increasing in the index, pushing the index higher. The contribution from these growing companies makes up for the loss in laggards, resulting in a net positive outcome over long periods. Because of this self-correcting phenomenon, the index always emerges from the down moves and trends higher over long periods of time. Therefore, averaging down on the index in bad times ends up delivering better than market returns. Let's look at an example using the Nasdaq 100's chart over a 20-year period. Despite several dips of varying degrees and lengths, the index always bounces back and continues its upward journey, led by contributions from growth companies including Apple, Google, Meta, Tesla, and Nvidia, whilst exiting laggards like American Airlines, Western Digital, and Fox Corp. Because of the net positive impact of winners in the long run, the only thing you must get right is to choose the right index and the right time. Let's now see how this plays out in the case of individual stocks. In the long run, individual stocks tend to outperform on strong fundamentals and underperform on poor fundamentals. There are only a few stocks that continue to perform fundamentally for long periods of time. Something in the business landscape changes, and many businesses fall by the wayside. Let's relook at the Nasdaq 100 index to understand this. Since the beginning of the index in 1985, only 4 companies, namely Apple, Costco, Intel, and Packard, have always been a part of this index. That's a sustenance rate of just 4% over a 38-year period. All the other 96 index components lost their glory or were overtaken by new entrants that were growing better. Some of these companies ceased to exist.
Can you believe that? There's only 4 that from all the way going back to 1985, there's only 4 companies that remained all the way through. That's nuts, right?
It just goes to show you, like, I think a lot of times people will assume, well, I'm just going to invest in what the top company was or the top 10 companies. And there's always a switching out, actually. And it gets me kind of curious, is like, there's always a switching out of the top 10 companies, right? It used to be the GEs of the world, then it was the Microsofts of the world, and then Microsoft actually lost out, and it was the Exxons of the world that became, in like the 2000s timeframe, that was actually one of the top 10 companies. And then slowly over the past 20 years, it's been emerging the technology companies. But you have to think, like, it's always sort of changing, and it's pretty crazy. If you're not innovating, it goes back to a funny tweet that I said earlier today, and then we'll get back to the video, which is like, man, I'd rather, it was a joke, but I basically said, why would you invest in innovating companies that want to reinvest back into themselves and continue to push America forward? I'd rather put all my money into companies that are strictly giving back all their money to shareholders, like dividends and buybacks, and not actually innovating anything. And this is the prime reason, because if you don't actually do that, it was a joke, by the way, but my thought process was like, if you're investing in back into the company, then over time you're going to keep up with consumer trends and consumer demands and exactly what people want to see, which it's kind of counterintuitive, but the customer's always right? If you don't have people buying your products, you're never going to generate revenue and your company's going to go to shit. So if you just create something that's great, but you don't continue to be up with the times, eventually people are going to stop buying your products and you're going to become irrelevant. And so that's what's kind of going on here. I assume people got excited because they're making generative profits, and then they're just sitting on their laurels and just giving all the money back to shareholders, but not continue to innovate, and eventually they get kicked out.
Yeah.
This after the demise of their businesses, and some of them filed for bankruptcy. In many of these cases, the stock prices went to zero and stocks were subsequently suspended for trading. Now imagine if you went in with a stocks only go up mentality against the 96 underperforming stocks. You may have averaged the stock all the way down, only to discover that all of those shares were worthless. This, of course, doesn't happen with all companies, but happens with many of them. Therefore, a fundamentally uninformed trader can be in for a rude shock if he follows the averaging down philosophy on individual stocks. A great example of this is the financial education channel run by the self-proclaimed investor Jeremy Lefebvre. Boasting over 600,000 subscribers, it pains me to think how many people would have lost fortunes following his averaging down approach. A few of his examples include Voyager Digital, Tattooed Chef, Honest, Planet 13 Holdings, and many more. Averaging down into these companies would have lost you huge amounts of capital, and often just as important, time and opportunity cost. Another factor that works against new traders is that most of the time they choose high-flying stocks of the time to play the averaging down game. This is an even bigger sin because many times these stocks never return to their previous glory. They get so overextended and overvalued in the euphoria that it gets tough to regain the glory once the business and sentiments normalize. Let's look at some of the recent examples of how averaging down in individual star stocks wouldn't have worked in real life. Here is the chart of Zoom Inc., a company that started its meteoric rise at the start of the pandemic, when everyone needed a seamless video conferencing platform. The stock went up 8x in a few months, and subsequently it started its downfall, coming back to the pre-pandemic price as the business faced tough competition from various other players, failing to capitalize much from its leadership position. Here is the chart of another pandemic star, DocuSign. This stock also met the same fate as Zoom, going up 5 times in a short period before coming all the way back down. Let's look at another example of what's strictly not to do in trading. Yes, I am talking about Cathie Wood's ARK Innovation Fund. The fund started off well, delivering a 7x return in 8 years to 2021. This was when everyone thought that Cathie could do no wrong. She kept accumulating shares in overhyped and overvalued companies with no regard for risk management. As the portfolio started crumbling when the rally ended, she made another mistake of doubling down or averaging those falling knives to the bottom. In some cases, like Nvidia, Cathie exited right at the bottom of its decline. Quite embarrassing for a fund claiming to be equipped with the best analysts in the industry. The same was the fate of investors who continued to average ARK on its way down. Kathy lost face in the meltdown, but even worse, the investors in her fund lost their hard-earned money.
See, this is where this guy cherry picks the data to make it fit his narrative that I'm not a fan of. Because imagine right now Nvidia went down post after the crypto craze has started to die down in 2021.
Right.
If you weren't averaging down, you wouldn't have made the money on the way back up again when Nvidia came out with the chips, the AI chips, right? Meta, same exact thing. Google, same exact thing. Microsoft, same exact thing. Amazon, same exact thing. These companies were not fundamentally like wrong by any means, but this guy's logic is, oh, you should never buy when things are down so much. Bro,
Yeah.
that's the perfect time to be buying. You just have to know that the company has the ability to pivot and get back into reshaping its destiny again. So I think this concept of not averaging down is false. And you can't cherry pick the data and say, well, every time you average down, you're going to lose money. Like, no, that's not how it works, dude. You just have to, you have to know what you're doing. You have to see that, hey, is the business like making money? Can they survive? Can they do well? Can they thrive? And, if they can, if the fundamentals are good, then yeah, eventually everything will recover. So
Yeah, and I want to state, I mean, I actually really, enjoy listening to Jeremy, the financial education. So I didn't necessarily know that this had this in there. Yes, he's made some mistakes. I've made some mistakes in my stock picks as well, right? And I think at the end of the day, you have to recognize that he's had some really good winners as well, like Elf and Tesla and Apple. He's done a pretty good job overall. I think anybody can pick and choose if you look long enough. Chris will make a mistake, eventually. I don't know. Chris hasn't made a mistake yet. No, I'm just kidding. But
I've made my fair share of mistakes.
I know. But that's the thing is like, I think because people like to point the finger at a guy and, pull him out of a crowd and make examples of him. But at the end of the day, people are always going to make a mistake. And people that are literally saying they're like, ha ha ha, like, look at this guy. It's just because they're trying to deflect on their own mistakes and push it onto somebody else to make themselves feel better. So pretty interesting that this guy chose Jeremy, but I actually really appreciate Jeremy's thoughts on some things. So
I think the key is just to look for companies that strong fundamentals, that have cash flows that are repeatable, and business models that are durable against a lot of downturns, right? And then figure out like, okay, where is this company or where's this sector in the market cycle? Is it on the up and up? Is it on the way down? Is it way out? And just buy and hold and don't worry about it so much after that,
Yeah.
So
the thing is,
yeah.
though, like, for example, you brought up Meta. I think that's a really good thought process. Is like Meta was still growing at unprecedented levels, right? And then it really was only 2022. And it got to a point where it was so dumb and cheap, but it was still growing at a pretty expansive rate. It made no sense not to buy it. Versus a DocuSign and some of those other Zoom and all those guys, the revenues were dropping expansively, right? Or contracting immensely, I guess is the right term, because expansively means it's growing. But they were contracting very, very quickly, which makes a difference, right? So I don't know, those sorts of things. It's kind of tough, and like you said, he was cherry picking to an extent because for a while everyone thought work from home was going to be the be all end all, right? I mean, out of your company, there's these memes out there that always talk about, oh, everything's fine, we're not gonna go home and hunker down. That it's like everybody's hunkering down at home, and management was like, we can work from remote forever potentially. And then it's like, no, actually, we want to trial everybody coming into the office once or twice a week, to the point where it was now you're doing this hybrid model, you're doing 3 times a week. And now it's like most companies now are starting to reinstate going back in the office 5 days a week. And you're like, how did we swing the pendulum within a matter of 3 years to saying we'll always be fully remote now, and everyone can be happy and you can live in Montana for all we care, to now being like, okay, now everyone has to be in the office back again 5 days a week. It's pretty interesting. And that's, I think, to be part of some of that kind of frothiness that's in the market. And you've even highlighted to an extent, not specifically those things, but when those opportunities arise, sometimes you just have to jump in them, and really get a hold of them as quickly as you can before the music stops. But you also have to recognize if something like that were to happen, and keeping in mind, you're doing a lot of due diligence during this time. You're keeping your eye on the market like a hawk, to be able to capture some of these things. And you also have to make sure you have the appropriate risk management strategy in play as well, because when everybody's looking for a chair and there's only 10 chairs and there's 100 people, you better make sure that you have one of those chairs secured, because otherwise you're going to be left holding the bag like a lot of people did on DocuSign and Zoom and many others. And I actually got screwed pretty bad writing some cash secured puts on Shopify. And there was a time where I just needed more and more capital. So I just let the loss kind of go. But had I kept onto it, I probably would have ended up coming out on top like TJ does, right? TJ has the capital to kind of withstand that. At the time, I just didn't have the capital. So I just took the loss and moved about my merry way. But yeah, it just goes to show you, man, when things dry up, they dry up quick sometimes.
Yep. All right, man. Maybe we can end it a little early today. I gotta get some rest.
All right,
I
my
gotta
guy.
sleep a little, man. I've just been, yeah. I'll see you later.
All right, my
Have a
friend.
good one.
Take care.
Bye.
I'll try to answer one or two of these questions, and then I'll hop off as well. But it seemed like we were answering them throughout. Let's see. Yeah, people averaging down on Palantir. Let's just see. QQQ. Continued sinking money. Yep. All right, my friends. Well, I think it's a good opportunity to call it there. Appreciate the 100 or so folks coming in there. While I have 100 of you on here, if you guys could just do me a quick favor and rush over to the Cashflow Chronicles TV channel and subscribe to that, because eventually we will be moving over to there full time once Chris and I get over 1,000 people, and just making sure that we can kind of seamlessly move over there. So it would mean a lot to us. We're actually this replay, this live stream will probably be on there tomorrow or a few days down the road. I'm trying to basically come up with the backlog, which there's now 59 episodes that we have to move over to there. So currently we're kind of booked out until the middle of the middle of January or something like that. And then will be kind of concurrent with everything going on this channel, and then eventually completely decouple. Now, it doesn't mean you get to unsubscribe to Matt Money, because obviously I'll do these ad hoc streams. Like yesterday, I did one for Christmas just to hang out for a little bit. And so, be sure that you guys be able to look at both, because obviously Chris and I would like to continue to grow Cashflow Chronicles and come up with more of a schedule week to week associated with that. We're generally doing the Tuesday through Thursday, but we're trying to come up, or at least I am, and I did run it by Chris as well. What exactly are we going to be doing on Tuesday, Wednesday, Thursday? Obviously, earnings time is very easy for us because we just talk about what companies reported that day. But specifically for like days like today, where it's literally just a random Tuesday, neglecting the fact that it's right after Christmas, but just a random Tuesday. Like, what are we talking about, right? Are we talking about how you can make your financial portfolio better, stronger, faster, or are you talking about a specific company? What exactly are we doing? But anyway, if you guys could just run over there and get us closer to that 350 mark, it would be much appreciative. We're really just trying to get it close to the $1,000 or not the 1,000 person mark. And we're trying to get as many streams up there. So like I said, today we talked we did a backlog release on Celsius. So if you're curious about our thoughts on Celsius, the price might be a little out of date, but all the information still holds, because I think it was right either the day after, the day of earnings releases for Celsius. So if you guys could just watch that one, if you guys curious about our thoughts on Celsius. We purchased it in the public portfolio today, so we're taking an initial position in that. So anyway, great day. Hopefully we will see you guys tomorrow. I'll catch up with Chris to see if he wants to skip tomorrow and see if he's all caught up on sleep and everything like that. But otherwise, I'll see you guys then. Much appreciated, and talk to you guys soon. Cheers.